Hello and welcome to our market alert video for today, which is August 11, 2023. I am Ken Moraif and I'm founder and CEO of Retirement Planners of America. And as the name implies, we are a firm that specializes in retirement planning. And so everything that we talk about is all through the lens of retirement planning. So what happened this last week that is important to us. And of course, that is that the numbers came out for inflation. And as we have been reporting to you for the last several months, we said that inflation would bottom in June, which it did at 3.0. And we said that inflation would start to pick up again. And we think that it'll trend towards 4% by the year end. And sure enough, we got the CPI numbers out this week. And guess what? Inflation is heating up again. And it went from 3.0 to 3.2. And as I said, we think that's the first step towards getting to that close to 4%. So what that means, therefore, is that there's still a lot of work to be done by the Fed. Now, what's driving this? Basically, there are three things. One is that the math of how they calculate inflation is going to make the number go up. And we've given you that in great detail in previous videos. If you haven't seen those, I encourage you to go to our website. They're posted there. You can watch them. But the math of it is that inflation is going to go back up. But the other two main components of inflation that are causing this are housing and wages. And housing prices are going back up again. There's a limited supply with high interest rates. People aren't moving out of their houses. They can't go up. It's too expensive. And so what's happening is they're staying where they are, and the supply of housing is dwindling. And of course, if you have demand with the low supply, guess what happens to prices? So housing prices are rising. In addition to that, you have wages that are staying high at inflationary levels. And why is that? Well, because a lot of companies gave people raises because of the inflation. And, if inflation is coming down, you can't go back to those people and say, guess what? We're going to cut your pay now. That wouldn't sit well. So a lot of people are still continuing to get those higher wages, and those are driving inflation as well. So we think that the job is not done. Inflation will continue to rise, and the Fed may have to raise interest rates some more this year. Now, this is counter to what it appears the market is saying, because right now there are a lot of people that think that inflation, mission accomplished. Remember George Bush when he's on that battleship? Mission accomplished. That wasn't the case, was it? And so we're thinking that towards the second half of this year, before the year end, there's going to be a big correction. We think we could see a 5 to 10% drop in the markets, the S&P and the Dow. Why? Because of what we're branding as inflation shock. We think that if we see inflation numbers come in higher in September and in October, people are going to start to question this whole notion that inflation is done and the Fed is done, and there's going to be some selling accordingly. Now, corrections are normal. They happen frequently, and they don't last that long. And usually they're gone before you even realize they happened, practically, because there's a lot of people that missed out. They wish they had invested earlier, and they keep waiting for the opportunity, but it hasn't come. The market has just gone up and up and up and up. So when they see this correction, they're going to see that as opportunity, and we could see some big buying there, which will correct the correction, we think, rather quickly. So overall, our view is that stocks are going to be higher at the end of this year, but there's going to be a correction between now and the end of the year because of that inflation shock, when people realize, oops, maybe inflation is not done yet, and the Fed isn't either. And so we think that fasten your seatbelts, but we'll play through that. Now, on the other side of the equation, on the bond side, we think that you should not be in bonds right now because of the aforementioned inflation and Fed not being done with their jobs. If that's the case, then bonds will suffer in that view, in that scenario, as they have so far this year, as we've been telling you they would. And so we think that it's not time to go back into bonds yet. In fact, we think it won't be until next year that it would be good. So right now, we're not in bonds. We're basically in cash, and we're being rewarded for that with low risk and pretty good interest rates at the same time. So the overall mix of how you should be invested is determined by you, your situation. I can't tell you that, but I would say that we should be invested in stocks, but not in bonds right now. Now, you may be wondering about this background. I'm actually in Colorado, and the forecast for today is 71 degrees. I don't know how I'm going to survive that. Gosh, 71. So left Texas where it was 104. So we're up here in Colorado, and my fam is going to be joining us. My oldest daughter and my youngest. My grandson will be here. So the 2-year-old Nathaniel, and I'm looking forward to spending time with him. And he's becoming quite the character. So that's all fun. So I hope you enjoy watching these videos. I encourage you to visit with one of our retirement planners. The link to our website is below. It's rpoa.com. And if you visit with one of our retirement planners, we'll build a retirement plan with you. A retirement cash flow plan, the RCFP, will help us to determine whether you can retire or not, where to get income. If you are retired, your income tax picture, when and how to take Social Security. And also we'll go over with you our invest and protect strategy. Because one of the things that we could be wrong about is that the cumulative effect of the Federal Reserve raising interest rates at such a rapid pace and so high could cause a dislocation that we're not anticipating, that could create a really bad bear market. And if that's the case, we think it's important to have a strategy in place to protect against that. And we do. Our Invest and Protect strategy is there to do that. And you can learn more about that by going to our website as well. So thank you for watching this video. Share it with as many of your friends as you possibly can. We want to help everyone to become a squipper, which is somebody who is retired and enjoying their second childhood without parental supervision. So thank you for watching this video, and we'll talk soon.